Real estate has always been slow and complicated, until Opendoor arrived. They pioneered iBuying instant cash offers for your home, often within a day. Instead of listing and waiting, sellers get speed and certainty. Here's how it works. You enter your address online, answer a few questions, and Opendoor uses data to make a cash offer. If you accept, they buy your house, do minor repairs, and resell it. Opendoor charges a service fee for this convenience, aiming for a small profit on each flip. But this model is capital intensive. They need huge amounts of cash to buy thousands of homes. When the market's hot, it works. When it cools, holding inventory gets risky fast. Opendoor is the biggest player in this high-stakes game, trying to disrupt an industry that's resisted change for decades. The company's promise make selling a home fast, simple, and predictable. But the real question is whether they can do it profitably, especially when the market turns. Investors are watching closely because bold visions bring both big opportunities and big risks. Opendoor isn't just flipping houses. It's trying to flip the entire real estate industry. The stakes couldn't be higher. Opendoor's stock has been a wild ride. In early 2021, iBuying hype sent shares soaring to nearly $36. But as the housing market cooled, the stock crashed, plummeting over 98% to just 51 cents by mid-2024. Billions in value evaporated almost overnight. Then, against the odds, the stock staged a dramatic comeback, rallying over 100% to nearly $7 by early 2026. Market value rebounded to $6.6 billion, signaling renewed investor optimism. Still, the stock remains far below its all-time high, a reminder of how much was lost. This volatility shows the fierce tug-of-war between doubt and hope. For investors, it's a lesson. Betting on innovation is a marathon, not a sprint. Opendoor's journey is a case study in how quickly fortunes can change. The question now, can the company turn this momentum into lasting success? Only time and execution will tell. Let's dig into the numbers. In 2021, Opendoor bought nearly 37,000 homes and raked in $8 billion in revenue. The next year, revenue doubled to $15.6 billion, but profits didn't follow. Instead, the company lost $1.4 billion as the housing market turned and home values dropped. Forced to sell at a loss, Opendoor slammed the brakes. Fewer homes bought, revenue fell to $6.9 billion in 2023. Losses continued, and by 2025, revenue was still declining and profitability remained elusive. Adjusted EBITDA stayed negative for years, highlighting the risks of the iBuying model. The lesson? Opendoor can generate huge revenue in a hot market, but consistent profit is another story. The company's survival now depends on smarter inventory management and a shift from reckless growth to sustainable operations. The numbers reveal ambition and a harsh reality check. Now, the focus is on building a business that can weather any market. Investors want proof that Opendoor can thrive, not just survive. The next chapter will be all about discipline. What caused Opendoor's boom and bust? Interest rates. Low rates fueled home demand and profits. Rising rates in 2022 cooled the market and crushed margins. Suddenly, Opendoor was stuck with overpriced homes and forced to sell at a loss. Meanwhile, rivals like Zillow and Redfin exited iBuying, unable to handle the risk. Their retreat left Opendoor as the last major iBuyer standing. This dominance is both a challenge and an opportunity. Investors were spooked, but Opendoor now controls the field. The company's survival through the storm is a key part of its story. Now it must prove its tech and strategy are truly superior. The stakes are higher than ever. So, what's next? Analysts expect 2025 to be another tough year. Revenue down, losses still high. But forecasts for 2026 and 2027 are brighter. Revenue growth returns, and profitability is finally in sight. Management aims to break even by late 2026 and post positive adjusted EBITDA in 2027. Some experts see massive upside if Opendoor can grow steadily and the market rewards its progress. In a best-case scenario, the company's value could multiply many times over the next decade. But these are just projections. Success depends on execution, market conditions, and a little luck. The groundwork for a turnaround is there, but nothing is guaranteed. For investors, it's about weighing the potential for huge gains against the real risks. The next few years will be critical. Opendoor's future hangs on its ability to deliver results, not just promises. The crystal ball is cloudy, but the opportunity is real. Opendoor isn't just waiting for the market to improve, it's evolving. The company is expanding beyond iBuying into new, less risky services. Opendoor Exclusives, for example, connects sellers and buyers directly, earning fees without buying homes. Partnerships with home builders and platforms like Zillow and Redfin are opening new revenue streams. At the core, Opendoor is doubling down on technology, using smarter AI to price homes more accurately and avoid costly mistakes. Better pricing means better margins and less risk. This two-pronged approach, improving the core business and building new ones, aims to make Opendoor more resilient. The goal, a durable, tech-driven real estate platform, not just a home flipper. Learning from past mistakes, Opendoor is building for the long term. Innovation is now about survival, not just growth. The company's future depends on getting this right. After a near-death experience, Opendoor hit reset on leadership. In September 2024, Kaz Najadian, former Shopify COO, became CEO, signaling a shift toward tech and operational excellence. Co-founders Eric Wu and Keith Rabois returned to the board, bringing back the original visionaries. Major investors like Jane Street took new stakes, boosting confidence. By late 2025, Opendoor added Lucas Matheson from Coinbase as president and promoted Christy Schwartz to CFO. The new team blends founder vision, tech expertise, and financial discipline. This isn't just about survival, it's about building a company that can win. Leadership changes are a big reason for renewed optimism. The right team can turn a struggling business around. For investors, this fresh start is one of Opendoor's strongest assets. The company is betting on experience, innovation, and a clear mission. Now it's time to execute. So, is Opendoor stock a smart buy now? The bull case. Opendoor is the leader in a huge market, survived when rivals failed, and has a new tech-focused team. The stock trades far below its highs, offering big upside if the turnaround works. Analysts see a path to growth and profitability, and new services could stabilize earnings. But the risks are real. A history of big losses, sensitivity to interest rates, and unproven long-term profitability. If the housing market stumbles again, recovery could stall. This is a high-risk, high-reward bet, a turnaround story in progress. Success could mean massive returns. Failure could mean more pain. It's not for the faint of heart or conservative investors. If you believe in the vision and the team, the opportunity is compelling. But be ready for volatility and uncertainty. The choice is yours. The biggest rewards often come from backing bold entrepreneurs. Opendoor is trying to revolutionize real estate, one of the toughest industries to disrupt. The company has survived hype, setbacks, and a brutal market correction. Now it's leaner, more focused, and led by a new team with a clear plan. The path forward is about discipline, technology, and sustainable growth. Before investing, do your homework. Read reports, understand the risks, and know your limits. Only invest what you can afford to lose. If you believe in Opendoor's vision and can stomach the risk, it could be a unique opportunity. If not, it's wise to watch from the sidelines. Make your decision with eyes wide open.